afternoon, everyone. My name is Jodie Gunzberg. I'm Managing Director of CoinDesk Indices, responsible for the product management and strategy. Thank you for joining us today to learn more about how we are defining and organizing the industries of digital assets by their use cases and technology to create a common language and taxonomy standard classifying tokens. At CoinDesk, we have the digital asset classification standard we call DAX that enables powerful use cases in crypto, just as GICS, the global industry classification standard, enables for traditional assets. So let's start with why choosing the right benchmark matters. In the book, Investment Management and Meeting the Noble Challenges of Funding Pensions, Deficits, and Growth, Ronald Sears, who is the co-host of Baby Boomers Investing Show and president and CEO of PPCA, points out a humorous analogy that picking an invalid benchmark to measure manager skill is like evaluating Tiger Woods as a bowler. So choosing the right classification standard probably matters a lot more than we give it credit for. And according to Larry Siegel, who's the research director at the Research Foundation at the CFA Institute, he says and has written that benchmarks determine the manager performance perhaps more than any other influence, including the manager's determination for success and the resources and skills that they put forth through the task. And we in the industry have largely ignored this, perhaps at our peril. So I agree with him because benchmarks often set the universe for the investments. So while choosing a valid benchmark has a lot of characteristics, one of the important things is what are the sector exposures inside of the benchmark, and how does that make a benchmark appropriate or not, because appropriateness is one of the key characteristics to make a benchmark valid. And we start generally with a market cap weight, and that's because it's the market beta or the systematic risk. And one of the characteristics of that is often high concentrations. So as we all know, in the S&P 500, over 50% of it comes from the top 3 sectors. We've got about 20% coming from the FANG stocks, so that's Alphabet, Amazon, Apple, Meta, Microsoft, and Netflix. And in order to address the high concentrations that may be appropriate for market benchmarks, it's not appropriate for all investors, so we modify those weights or focus on things like factors or sectors. Now, given where we are with digital assets, which is a much more emerging asset class, we have a much higher concentration. It reminds me a little bit of what the Dow was like in the 1800s. And we've got over 90% of the market covered with our 2 biggest sectors in currency and smart contract platforms. And that's mainly coming from Bitcoin and Ether that together make up over 60%. And the top 10 digital assets cover about 80% of the market. The top 50 assets cover 93% of the market. And the top 100 assets cover 96% of the market. And we'd expect that as the market matures, that we'll see more diversification across the board. But we may always have a high concentration in a market cap weighted index, and we'll adjust them appropriately for investors the same way that we've done in traditional assets. Now, sectors aren't just for helping determine whether a broad benchmark is appropriate, but they're often standalone, and they're the most appropriate indices for sector-focused funds. And they start with the benchmark universe and the starting weights, and they're used for performance attributions. Hedge funds also use them. They often go short the sectors and long the individual assets to isolate the alpha. And these sector funds are also generally used in a lot of the sector rotation models and risk management models, and they underpin the ETFs that allow easy investment access across the basket. These are so popular that they are now almost 50%. So 50% of all of the indices in the equity markets are made up of sectors and industries. And the media loves them too. Of course, every major media outlet, tier 1, has a sector beat, and this is because everybody just wants to know what's hot and what's not. And it's pretty much, once you know whether the market is up or down, the next question is what drove it. And often you can find those answers by analyzing what happened inside of the sectors, the industry groups, and the industries to tell those stories. For example, in the latest drawdown after the Fed raised rates, we looked across the board, and of course, most of the assets fell. Inside of one of our well-diversified indices that supports Web3 product, it's called the CoinDesk Industry Group Select Equal Weight Index, or DIGS. We have the top eligible asset from each of the industry groups, so currently there's 10. And you can see that there's a big difference between the 30% drop in ETH, which is of the smart contract platform sector, and the single coin industry group, is only a little less than half of the drop that we had in Decentraland and Mana. That's the culture and entertainment sector. That's part of the metaverse industry group. So even in a down market, the dispersion and the volatility still generate a lot of alpha opportunity. But you need to be aware, and we need to keep these sector and industries up to date, because what changed is the risk profile. While Mana was the worst performing asset, over the past year, it was the lowest correlated. And just in the last 30 days in this drawdown, it became the most correlated industry group to all of the other industry groups. So the risk profile changed, and you really need to take that into consideration when you're constructing your portfolios and managing your risk. So in order to keep pace with our market that's moving very fast in the digital space, we are constantly updating the DAX. And again, I'd like to highlight the importance of the quality of the classification standard that we're using. And we're very fortunate at CoinDesk to have both industry experts in the traditional indexing space as well as in the crypto space. In fact, at CoinDesk, we have the first crypto index ever calculated, the CoinDesk Bitcoin Price Index, that's been ticking every second since November of 2014. And we take the expertise from not only our internal team, but a lot of external contributors as well, in order to help us identify what is assigned in the industries. And every month, on the 15th of the month, we assign each of the top 500 assets to one of 36 industries. Each of the industries go into one of 23 industry groups, and each of the industry groups go into one of 6 sectors. And the hierarchy can change, and the definitions can update, and we're constantly monitoring that and updating that. So you can find on our website the entire glossary, which I promise you is the most interesting glossary you will ever read. And you can also find the list of every single asset with every one of their industry group, and sector classifications, and you can also find the hierarchy there. So I'd like to leave you with a couple of key takeaways, because to have a digital asset classification standard is very important for making the essential decisions that we need to make for tactical and strategic allocations. And just as the GICS serves the traditional markets, the digital asset classification standard does serve for an accurate, complete, and standard definition of the digital asset industries. And this can help identify the investment opportunities, evaluate the impact of sector trends on your portfolio, analyze your sector contributions to the portfolio performance, measure your benchmark exposures to your peers, and build well-defined sector-focused and sector strategies. And to understand what are the industry group and industry drivers that are contributing to the performance and the risk of the sector. So with that, thanks again for coming this afternoon, and feel free to reach out to us if you have any questions or need more information.
Don't we have a 2-minute transition?
I think
Okay, I thought we had a break here. I guess we don't. So we will go right into it. I'm Kevin Reynolds. I'm fortunate enough to be editor-in-chief of CoinDesk. And you've already met Jodie, obviously. With me today also are Kristen Mierzwa, head of digital assets from FTSE Russell, and Tarik Riviere, head of commodity and crypto index products at Bloomberg, my old shop. So I'm going to go for some questions. First one's to Kristen. Where are we now with digital assets, indices, and where are we heading?
So I know you guys have been listening to a lot today, so I don't want to overwhelm you with a ton of everything that's happening with digital asset indexes, but I want you to walk away knowing one thing that I think all the index providers are doing, and that's wrapping around a lot of great governance and policy around how we're evaluating the digital asset opportunity. So I'll just give you one quick story, and then we can go into the future of things. So FTSE Russell started thinking about digital asset indexing in 2018, and at the same time we were thinking about private equity. And flash forward today, we've got digital asset indices, but we haven't quite cracked private equity in the way that we'd like to. And we had the same problem with both of those asset classes, and that was figuring out a transparent, clean price. So in terms of getting that together for us for digital assets, we needed to go find a partner who could help us be a price aggregator, and then get into all that governance and how do you pick which exchanges do you use, which assets do you cover. So what we did was partnered with Digital Asset Research in 2019 officially, and got some indexes up and running, just indicative indexes. And then from then until now, what we were really working on was a framework to ensure, like, hey, we can offer a robust product for institutional clients that would be appropriate for passive vehicles. And we have 318 assets in our eligible universe. 43 of them are EU BMR compliant and can go into indices that could be listed in Europe. But we use 21 criteria to vet the actual exchanges, and after that process from, I hear different numbers, how many digital asset exchanges are out there. It could be 450, 600. I heard that in Australia there's 300 if you consider two people with a wallet. Is that an exchange? Is it not? But in our universe, after we go through that 21 criteria, we come down to 11 vetted exchanges, and we VWAP that price in real time, and I have a feeling you guys are doing something very similar. And then we also take it another step further, and we vet the assets themselves, and we do this on a quarterly basis. So our universe comes ebbs and waves, but it's been going bigger and bigger, and we're getting some great data in this process. But I'm going to give you one example because that kind of brings it to life. We had XRP in our universe in our eligible universe for benchmark assets prior to the SEC investigation on them. And one of our criteria is that there can't be any pending regulatory issues. So we had to move them out of that benchmark asset eligible universe, and they're on our watch list. But we've got, again, tons of criteria that we're going through all the time. So I know that was a lot on governance, but it's really important, and I'm sure all of us take it very seriously. It's the backbone of everything. And then where are we going is definitely beyond Bitcoin only. So of course, multiple digital asset indexes is what we're all working on. But I think what's really interesting is when our clients come to us and say, hey, I've got this idea, can you help me with it? And it would be things where they want to mix digital assets in with other asset classes themselves. So you could do target volatility by adding a fixed income component. You could do an equity index where you maybe just sprinkle in 5% of either a digital asset or a basket of digital assets to get that digital asset boost. You could hedge to a digital asset rather than hedging to another fiat currency. The possibilities are endless. And in the prior sessions today, I heard a lot of people talking about, is it an asset class or is it kind of like tech where it's just prolific in everything you're doing? And I think it's both. And we're going to see people really just integrate digital assets into their portfolios, and indexing will be a big part of that.
It's a great way to look at it, the combination, and we definitely have that same thinking that there's part asset class, part exploration.
Yeah.
And, yeah.
So,
Kevin, if I can just say something about the question of if it's an asset class. I think what it really depends on is which use case are you looking at? Because if you look at something like Bitcoin, it really falls in the store of value asset class in the super asset class framework, right? But then if you look at something like Ether, you're looking at a capital asset because, right, you're earning a piece of the fees of the global settlement layer. You're also looking at the commodity asset class, the transformable consumable asset class, right? Because that is you're burning ETH for every computational step on Ethereum. And then it's also store of value. That's the third major super asset class, because you can use it for lending and digital assets. So this is new, and I think that this is part of why we're seeing so much confusion between the SEC regulation or the CFTC regulation or something else, because it's new. It doesn't quite fit into the asset classes the way that we've known it to be.
Agree.
yeah, which is why the SEC and CFTC are going back and forth. So Tarik, so question for you, on a related thing. Can you give some of the practical challenges, give us a sense of the practical challenges and trade-offs one encounters in trying to, in attempting to define and measure the crypto market?
Yeah, very happy to. So, I mean, the good news on the starting point is that first challenge is really a byproduct of all the excitement in the space. And we are really, crypto is still one of the most exciting corners of the capital markets. And we're really seeing that. We've seen that today. We're going to see it in the next few days. But that comes at a price. And the price is the incredible pace of innovation that's unrelenting. In the space, we're seeing dynamics that are it's a space that remains turbulent and exploratory. And so you're seeing a lot of turnover, like changes, rotation in our relative market cap. And the problem when you're designing an index or a benchmark is how do you capture the shifting trends in the space while ignoring the noise? Because obviously, if you come up with a mechanism and you aim for fidelity to the underlying space and you're trying to be responsive to the changes, you can have a very high frequency mechanism that will change and rebalance all the time, and you will track all these variations, but then you generate a lot of turnover, and that's not useful to the end investor. So what do you look at? The first thing to look at is the frequency of the rebalancing. So very popular constructions are monthly or quarterly. We do something at Bloomberg that is a bit of a hybrid. So we are going for the monthly rebalancing reconstitution to really pick up on any changes in the space. But we do have a 3-month trailing window, a buffer rule, that ensures that only those changes that are really stable, that persist over time, get baked into the index. So that's the first challenge. There are some challenges in the space that are not unique to crypto. I mean, other asset classes have had the same problem. Just talking about just mere mechanism and how edges have to be updated on a monthly basis when you do rebalance your portfolio. That's something that's been implemented, tried and tested in the commodity space for a long time. You need to, as a replication provider, there's probably overly a lot quite technical for that time of the day, so I apologize not being as nice as you are, but I'll go into those details anyway. You need to update your edges when you're providing replication, and if you don't do that right, you incur slippage. That's a cost that ends up going to the end investor. And so there are mechanisms that we put in place where we actually have a period of time between the announcement date and where we actually target the weights for the next month and the day they actually get implemented. And the trade-off there is that, yes, that reduces slippage, but that means on the first of each month, the observed weights are not exactly, there's a slight divergence between observed weight, and the ones we targeted. So But because we like to feel special in our asset class, there are also some challenges that are quite unique to the crypto space. And I think taxonomy is one of those. And I think like it's part of conversation increasingly. And the difficulty there is you have over 1,000 tokens. So the effort to actually first establish that taxonomy and just maintain it over time, it's a very big effort. And we're fortunate to be working with digital asset research as well. And obviously, we had our DeFi index coming out successfully in August 2021, largely leveraging their work. In taxonomy, though, I think there are two challenges and trade-offs that are shaping up on the horizon. The first one is the notion of formal classification. So most taxonomy or classification, what bucket a token falls into, the problem there is that there are certain determinations that are easy to make. You can decide that someone is, a token is, say, a Bitcoin opcode derivative, and it, and it has a certain use case versus a smart contract platform. That really is black or white. But when you go into the smart contract platform and you move up the layers and you look at the application layers there are some use cases where the separation between them is a lot more blurry. DeFi, GameFi, Web3, are there like commonality there, and are there tokens where you can't really actually fit them nicely? So is it fuzzy classification? We are spending a lot of time having that quality debate internally. And then there are, obviously other consideration around taxonomy, but I think these are some of the challenges really we are facing.
Okay. Jodie, last question for you. Given the emphasis on converting GBTC to an ETF, I'm sure we've heard of GBTC. How important are underlying indices to the listed products? What I mean is, since there's already ETFs on futures and there are crypto ones using equities, does spot matter?
That's a great question. I think that the underlying indices are extremely important to the products that track them. And there's a huge difference between futures and equities and spot. And we've seen product out there on all three of them. And while it's a little bit hard to do all of the analysis on crypto because of the shortness of the data, we're limited by the length of the history. What we can look to for sure is what happens in the commodities markets. And we see that the correlations between the equities indices that are following things like oil producers or agribusiness or metal miners is that the correlations of those are very high to the equity market. So there's a lot of equity beta there. And the same thing happens with crypto, where you've got companies, publicly listed companies that are in the business of crypto, and then they've got all of this equities market beta, and then you're doubling down on the high technology concentration you got in your S&P 500 anyways. So, you can look at the title of an ETF and be like, oh yeah, that's a great DeFi index, but unless you really look under the hood, you don't understand that you may be buying equities anyways, just more of the same thing. And then as far as futures go, they're a little more complicated because there's the term structure. That's the curve from the contracts that are expiring at different times. And what is interesting in commodities is that when there's an excess of inventory, you get the later dated contracts priced higher than the near expiry contracts because it's including an expensive storage cost. And when there's a shortage, you get the later dated contracts that are cheaper. Now, in crypto, it doesn't mean the same thing because there are no expensive storage costs. So if you expect the price of crypto, of Bitcoin, to go up, then your later dated contract will be more expensive. So when your contract is expiring, you sell something cheaper, you buy something more expensive, you go long the futures-based ETF because you thought that it was going to go up, and then you get hit with the, we call contango. It means with storage cost, even though there's not much storage cost there. So it works against you. And if you think the price is going down, then you've got the opposite problem, because then you'd be short, but you're making extra return from the shape of the curve by selling the expensive contract and buying the cheaper contract, and it works against you even faster. So there's a fundamental problem with futures-based crypto index-based ETFs that, if somebody wants to approve it or not approve it, that's fine, but it doesn't make a ton of sense to have a futures-based ETF approved that's linked to the spot asset, especially when you can buy the spot asset. It's not like oil. Like, to buy spot oil is like illegal. Like, it's poisonous. Like, Bitcoin might be volatile, but I don't think it's poisonous. So, you've got a scenario here where it kind of would have made sense to either approve both or neither and let investors decide what they want to use for what purposes. But unfortunately, we don't have that case. But anyways, it's very, very, very important always to know what are the underlying exposures in the indices that are underpinning the ETFs, so that you can determine whether it's appropriate for you or not.
I have a question for my fellow panelists. What surprised you most when you first got into digital asset indexes? Like, was there something like, oh, I can't believe this, I didn't see this one coming?
Yeah, well, there's certainly a few surprises. One thing that really did surprise me this year is that we spent a lot of time thinking about a disaster scenario, because we assumed that the space was the most volatile, and I'm sure it was the same for you. We in the methodology document, we spent a lot of time thinking about, doomsday scenario. What happens if something can't price? And because traditionally we've thought of these issues with crypto, and we thought that the only investors who would suffer from these issues would be in the crypto space. And it's interesting that earlier this year, actually, when it came to index, the problem occurred in other markets because of the situation in Europe. And so we've seen some of those scenarios play out, not in the crypto space, but in other asset class that, quote unquote, we thought we'd never experience this type of disruption. And I think some of the lessons learned there is that, a lot of these situations we can handle. And, as long as you communicate well and in a timely manner, you're transparent, you're open about what it is that you want your index to do, I think that works well. But yeah, that was a bit of a surprise. Yeah.
I think probably the most surprising thing for me has been the disparity in the quality of the data. I mean, I was just looking at the most recent drop, again, after the Fed raised rates and everything fell, and I'm looking at the drawdowns. And I pulled up a couple of different Bitcoin indices, and I found an enormous difference. I was looking from April 1st to May 11th at the time, and I saw over a 5% difference between two of the Bitcoin indices that I was looking at. And I'm like, wow. I'm like, that would, you look at the S&P 500, the Russell 3000, whatever, FTSE, all of these different things, and it's like, this is a huge difference over not even a 6-week period. So to know the quality of the data is important, and to be able to dig down into what's reliable, understand your sources, look at multiple sources so that you can see the range. As an analyst, to just rely on one source might be a mistake in this space, because again, it reminds me, again, a lot of the commodities where, what's the price of oil? Well, if you go to somewhere like S&P Platts that's collecting every single spot market transaction, you don't really know. It's like, well, the last transaction was X, right? And then they feed it all into the exchange, and they create a reference price that underpins the futures contract. The same kind of things are happening here. So you get these reference rate indices like the Bitcoin price index, the XBX. It's a reference rate index. And it's not so simple in the infancy of this market. And not until the market develops and matures can you really go to one place and get what looks like a reliable liquid price that's the same everywhere. So that's going to take some time and maturity before we experience that. But I didn't realize how different it would be, I think, until I actually saw it.
Yeah, another thing that's a little surprising is, or I think specific a little bit to the space, is the importance of those exclusion factor on.
Yes.
Yes. So
maintaining exclusion lists.
Right.
Yeah, I did not know that that would be my new life, because everyone's got different custodians, different regulators, so you have to do everything bespoke to that. They may be beholden to what their portfolio manager can get access to. So yeah, a lot of exclusion lists.
But that hits the core of the question, what are we measuring? I mean, we are measuring, it's not really indices we come up with, it's investable indices. Yeah. So they don't make sense outside of the possibility of replication, and that doesn't happen if you can't custody it, right? So
indexing is always more complicated than you think.
Yes. Yes. I think we've reached time. Can we go further? What?
That's it. It's 0 now.
No? Oh, we can. Okay. Oh, okay.
My editor-in-chief, my beloved editor-in-chief, Kevin Reynolds.
Thank you.
But there are some things in which I get to tell him what to do. Not many, right? Independence and all that. Sorry. Time is one of those. Okay. Off the stage, dude. Thank you to the wonderful panel. Great job, everybody.